In this video, we explore why implied volatility varies drastically across different strike prices. The Black-Scholes model, which we touched on in Phase 2, assumes volatility remains constant across all strike prices for a given expiration. However, reality proves this wrong. If you plot implied volatility against strike prices, you rarely see a flat line. Instead, you see a curve indicating that the market assigns different volatility expectations to different price levels. This curve manifests in two primary shapes, the smile and the skew. A symmetrical smile is often found in forex markets, where traders fear an extreme move in either direction equally. Both deep out-of-the-money puts and calls demand higher premiums relative to at-the-money options, creating a U-shape on the chart. In equity markets like the S&P 500, we observe a skew or smirk. Here, OTM puts trade at significantly higher implied volatilities than OTM calls. As you move lower in strike price, the 4 rises sharply, reflecting the market's pricing of fat tail risk, the higher probability of a sudden market crash compared to a sudden melt-up. Why does this skew exist? It is largely a structural legacy of the 1987 crash, after which institutions began aggressively buying OTM puts for portfolio protection. This constant demand for downside insurance bids up the premiums of puts, structurally inflating their implied volatility relative to calls. Understanding skew is vital for the strategies we will cover in phases 5 through 10. For example, when selling vertical spreads, the skew explains why you often receive more credit for selling OTM put spreads than call spreads of the same width. You are being compensated for taking on that perceived crash risk. Thanks for watching, and join us next time for volatility term structure.